So I'm sure everyone watching this has seen in the news today that over 20,000 farmers have gone to London today to protest against the Labour Party's recent changes to the inheritance tax rules, which will bring many farms into the inheritance tax regime that just weren't there before. Nobody understands why the Labour Party has decided to do this. Many think it's very short-sighted. I agree with that. How should a farm or any business, therefore, because business relief in general has been affected by this, how can any business expect to survive if on the death of parents, family business is being passed down the generations, that the children are going to have to find whopping amounts of tax to pay this really unfair tax bill. People pay income tax, capital gains tax, national insurance, corporation tax throughout their working lives to build up a family nest egg to pass down the generations, and the Labour Party, who is supposed to be on the side of the working class, are therefore taking off these assets from people who aren't multimillionaires at all. They just want to work their business and pass their business on to their family and create what is often called bloodline protection. How can you ensure these assets get passed down to the next generations? So what changed in the recent October budget? Rachel Reeves decided to announce plans to reform agricultural property relief from April 2026. Currently, all qualifying agriculture and business property is fully exempt from any inheritance tax. Inheritance tax has been around for hundreds of years, but a quite sensible government back in the day decided it wasn't sensible to impose a tax when a family member dies, passing a business down to another family member to tax that business. The business would die, the business would end. So why on earth this Chancellor has decided to bring this tax back in at this time is just beyond me, because they want to stimulate growth. This will not stimulate growth. It's not just going to be farms, it's going to be all businesses. But right now in the press, the farmers are quite rightly outraged, and I'm over the moon that over 20,000 have gone to London today to protest against this. I think it's a big thing in our country that we've stopped kicking off and protesting about the right things that need protesting about. So fair play to the farmers for doing that. So currently, as I say, business assets, farm, agricultural property can be passed down the generations and no tax paid. So on the death of parents, the children who are going to take over the business can continue to just run that business seamlessly, therefore, going forward. The big change from April 2026 is that the inheritance tax exemption will be limited to £1 million of assets. Now, I grew up in the 1980s. If you heard someone was a millionaire, you would think that person is absolutely wealthy as hell, loaded, sorted for life. £1 million in 2024 is not the assets that it once was. You couldn't buy a decent house in London for £1 million. So how much would a good farm, a sizable farm, be worth when you add up the value of the land, the value of the property on there, even the machinery, combine harvesters, all that sort of stuff, cattle, how much is all that worth? So the fact that you're going to pay inheritance tax on values above £1 million is absolutely obscene. Yes, this rate of inheritance tax may have been reduced from 40% to 20%, but it's still going to be a hefty tax bill that the children of these families are going to have to find when parents pass away. And normally inheritance tax has to be paid within 180 days of the person who passed away, who had that liability arising. The government has estimated that only 500 of the UK's current 209,000 farms will be affected by this. However, there are estimates out there that the number could be close to 70,000 farms. 70,000 might be a little bit on the high side. One thing for sure is 500 is crazy as batshit, because there is definitely more than 500 farms in the UK that are going to have assets well in excess of £1 million. And yes, I saw the BBC report this morning which said, well, what happens if a person's married and you can claim relief between spouses, you can have a residence nil rate band. Well, what about people who aren't married? Why should you be taxed more if you choose not to be married? You may have been divorced, etc., etc. It is a totally unfair tax. So what can people do to prevent this tax being paid? Well, the answer is not a lot, because the tax legislation's coming in. Yes, protest about it. Let's see if we can get the legislation changed by putting pressure on MPs, etc., going forward. But one thing that people can do, which is a simple solution, is to insure against it, and that's what we want to discuss on this short video right now. So, how much inheritance tax could you be subject to? Wealth of Advice are independent chartered financial planners. We have been offering inheritance tax solutions for many clients for many years. We would sit down with a client, do a full analysis of what all of your assets are, go through all the different reliefs and exemptions that are available, be looking to utilise all those reliefs and exemptions. Obviously, we're talking about farms and farmland here. One of the things that people can do with their assets to avoid inheritance tax is to put assets into trust. You're not going to be able to do that with a working farm. Well, there might be some instances where you could do that, but for majority of people, who have a working farm, it's not going to be possible to put that particular asset into trust and continue to keep using it. So on your death, you can leave everything to a husband or wife if you're married, and there's no inheritance tax between husband and wife. That's the interspousal transfer relief. But each individual is allowed to have £325,000 worth of assets. There is a residential nil rate band of £175,000 that can be added to that. If your estate exceeds £2 million, that residential nil rate band is effectively lost by £1 for every £2 of assets you have above 2 million. So basically, for anyone who owns a farm, is married, what we're estimating is that you could have a total estate of around about 2.65 million, and then anything above that, inheritance tax would be calculated on the amount above that. So as we said at the beginning, for the majority of people who have a decent sized farm and some other assets, more than 500 farmers and farms will be brought into this new regime. So one of the solutions, without having to carve up assets, give assets away, make significant gifts, put things into trust, one of the solutions that we're talking about today, and again, this solution may not be correct for you, and what we would recommend is that you seek full advice from a good chartered financial planner, a firm like ourselves obviously, who will cover all of the assets that you have and look at what the best solutions you have available to you. But one of the solutions that we're talking about today is covering an inheritance tax liability through taking out an insurance. So the chart that you can see on the screen now shows where there's a male age 60 with a wife who's age 55. Some woke person watching this would probably tell us that we shouldn't make the man older and kill him off first and the woman younger, but we're just doing some illustrations for the purposes of what we want to get across here today. However, if you have a joint life second death whole of life policy, which is an absolute mouthful, but basically what it means, you have husband and wife who take out an insurance policy for the sum assured quoted. So let's say your estate is worth 4 million. You take off the 2.65 million we're saying that you're allowed to have as a tax-free estate. That leaves an estate of what, 1.3 million, 1.3.5 million. Times that by 20%. Your inheritance tax bill might be £600,000 in that example. So if you're a male age 60, your wife's age 55, you could take out an insurance policy for £600,000. It would cost you £567 a month, which again sounds like a hell of a lot amount of money. If you live till your average life expectancy, which is age 87 for the female in this example, you would pay total premiums of £217,900. But on that second death, £600,000 would be paid out to the family, which will be used to give the government their piece of flesh, their inheritance tax, which Rachel Reeves believes is going to rebuild the NHS, etc., etc. So that would cover that. The farm wouldn't have to be sold, the assets wouldn't have to be carved up. The family would receive that on production of a death certificate. There would be relevant forms, etc., signed in advance. This is totally flexible as well. We could increase the sum assured during your lifetime within certain limits. If a future Conservative government came back into power and done away with all this, we could cancel the policy. In the future, you're not tied into it for life if you don't want to. We would obviously recommend, if you're going to set up an insurance policy and you need it, then obviously you keep it. But what we give on the screen there was just some examples of different sum assureds, how much it would cost each month. And the key thing in that third column is to show that if you and your wife, or you and your partner, you and your husband, whoever it may be, lives to your average life expectancy and you continue paying those premiums, you should pay a hell of a lot less than what the sum assured would pay out to be. So yes, this is definitely another tax that you will look at and say, well, as a result of this, in that example I give there, where you're going to get £600,000 paid out at age 87 for the female to pass away in that example, it's only going to cost you £217,000 for £600,000 paid out. I 100% agree we shouldn't be having to go down this route. You should never have changed the rules in the recent budget, but this is where we are. And we think using a simple insurance policy that's been around for over 100 years. People have used whole of life insurance for this for so long. Obviously over the last 20 years, I've given advice for over 20 years. I do think as a result of these recent tax changes that more and more people will be looking to take out insurance to cover this potential unwanted tax bill in the future. Go and see an advisor firm who are not linked or tied to anyone. We aren't. We're totally independent. We just mentioned this as a possible solution. There may be other solutions out there. You may have other assets which could be used to pay a tax bill. You may prefer to do that. You may have ideas to sell a business to bring the family members in sooner than that, and then you may survive the 7 years. There is all sorts that you can be looking at to doing. You shouldn't have to, as I say, this shouldn't have come up in the recent budget, but here we are. So if anyone would like any advice on this, please don't hesitate to get in touch, and Wealth of Advice will be very happy to help you on this matter.